the markets go through swings and roundabouts. There's more money, there's less money, there's access to this. We're in a good economy, we're in a bad economy. The thing I would say is, for everyone around this table, your business is to an extent insulated from that, because you're hopefully aiming to grow at huge percentage increases, whereas your Shells of the world, or one of the big companies, it's a 3 to 5% growth rate, and therefore those changes make a huge difference. For entrepreneurs, actually, just going out there and doing what you do, it's going to attract interest from funding, hopefully from a sales perspective. So actually, don't try and go, what are you seeing? What's going on in the market at the moment? What are the trends? Focus on what you're doing, do that well, and the rest will follow. The other thing I'll probably say from the outset to say to everyone is, we'll probably end up having a conversation in a second in terms of, I'm going to pass to Nick in a second and say, what are you guys looking for? That's great, you know what he's looking for. Do not design your business to go and attract funding, because if we did, everyone in this room would end up having a SaaS business with high margins, 90% sticky customers, all going B2B about AI and cyber or something. You're going to be homogenous. You're all doing very different things, and it's great, the variety around the room. Do what you're passionate about, because if you're passionate about it, you'll be successful and you will attract interest. It might not be from Nick, it might well be from Nick, it might be from somebody else. That's what you want to aim to do. So don't listen to everything that you're probably about to hear and go, I need to do that, and that's what I should be focusing to do. I'm B2C, I'm suddenly going to become B2B. Well, if that's a strategy, great, but don't change what you're doing to attract funding. I'll come probably onto this later. Some of the best businesses I've seen have never raised a penny. And it's something just to keep in the back of your mind. We'll touch on alternative funding routes and what else you can do. Your revenue is your best source of funding. It's free. It doesn't cost you anything. Actually, it makes you more valuable. So, always think about that as well from a perspective. Nick, do you want to say what you guys are looking for?
Yes. So, Foresight has lots of different funds, and all of the different funds look at ever so slightly different things. So we have deep tech funds, we have sort of growth funds. I work predominantly on the growth funds, and as a house, we've always tried to be slightly more conservative than some of our competitors in the market. So we are looking for businesses which are raising money to move to the next stage. They have their product, they have a growing track record of product market fit, and they are raising money to really start accelerating and going through the gears. So what that means is, to us normally, is about 1.5 million quid of revenue and growing sort of at a decent click from there. And sort of what we try and look at is the first round that we put in, which from the VC side is somewhere between 2 and 5 million. If things went well, that would be the last time they ever raised money. But we know that with the pockets we have and with the best one in the world, that almost never happens. We can then follow, and then we follow for either the good reason, which is you need more money to grow even faster, great, or as we see more and more often, sales don't come quite as quickly as you'd hoped, but costs ramped up a little bit faster than you hoped. And so there's just a little bit of a dichotomy there, and so then we go again, which is sort of pretty standard for the way that we've done it. I think the traditional American VC approach would be you invest in 10 companies, 8 of them go pop, 2 of them return the fund. We are much more English than that. We sort of invest in 10 and we might have 1 failure, but we're investing at that slightly later stage, and we are expecting all of those with a squint to sort of get to a nice return of 3 and 5. We might have 1 that goes pop, unfortunately. We might have 1 that explodes and becomes a 10, a 20, whatever else it might be. Are there any sort of more macro global trends that we're seeing at the moment? With all the stuff going on sort of politically and with tariffs and all that sort of stuff, we haven't really seen investment slow down that much. We've had to do a massive review of our own portfolio to see how that is impacting things. We always ask the question of companies if it's relevant. Is it affecting you? How is it going to affect your growth? That sort of stuff. But we're not seeing the level of businesses coming to market slow down. We're not seeing it impact that many businesses yet. It sort of remains to be seen what the impact on the US economy might be and things like that. But we don't have any real horrific macro problems at the moment beyond the ones that are affecting everyone and creating a bit of uncertainty. So is there, and I think the only just sort of the kind of advice following on from there is what we're seeing at the moment is, particularly with tech businesses, lots of very complicated businesses. And one of the real sort of litmus tests for me at the moment is, and everybody around the table did it well, is can you actually explain what your business does in 2 minutes? And it's the most frustrating thing in the world when you have a call with a founder for an hour and you put the phone out and you go, I have no idea what they do. I don't know what problem they're solving. I don't know what their product does. And you kind of go, and then you just have to ask yourself, can I be bothered to pick up the phone and actually find out? Or is it just easier for everybody if I don't? And so just sort of making sure that even if it's in your deck or in that phone call, like within 5 minutes you go, this is what we do. It sounds pretty basic, but it's actually amazing how badly some people do that.
Yeah, I think I see that quite a lot where, somebody will send me a deck and I'll have a look at it and so that, and you're so in your business, it's second nature. So you forget to go to I've got somebody that I'm working with at the moment, they're in healthcare. So it's sciencey, and it's something that, to be honest, even if you're a scientist, you might not have come across it because it's at the forefront of something great, but they just start using all this terminology throughout it. And I'm like, you're going to probably, most of your investors are not going to be expertise. We'll talk about the funding stages in a second. Angels, you might find people who have done something similar and have some expertise. To be honest, as soon as you get through to the institutional stage, Foresight are agnostic. They will look at most things. Therefore, they're not focusing on this. They're not going to be tuned in exactly what you guys do. So it's just try and take yourselves out the weeds to explain to people what you do. If I have a look, I've got a nice list of things here in terms of coming back to what do investors look at. I think it's worth maybe talking for a second about the different stages of raising. So the first point is everyone likes to put things into nice buckets, right? So it's to go, this is seed, this is Series A. Everything's on a spectrum. You could get around that somebody calls Series A, but to somebody else is a seed and vice versa, or whatever it is. What I would more think about is, we'll talk about how much you should raise, but is who are you going to go to for your capital? The reality is if you're going to angels, you're going to need ultra high net worths if they're going to be writing you millions of pounds. Somebody who's got a net worth of 20, 30 million pounds isn't going to, unless they really love you, isn't going to write you, a check for 2 million pounds because that's a significant portion of their wealth. A billionaire might, but you're talking about a very small number, and really they're going to be interested because they've got so many other things that are going on. So it's really identifying where you're going to go for your capital based on that. If you're looking for checks of hundreds of thousands here and there aren't many VCs, an institutional side of that, who do that. So you're looking at angels. You're into the millions, you're probably more likely to look at institutional side. In both of those scenarios, and this is the case, I talk about this at M&A when people are selling, there's numbers and there's metrics and there's stories and everything like that, but really it's, Nick touched on this a second ago, it's people to people. If Nick's got a business, as he just said, where he comes on the phone and goes, I don't really know what it was, they didn't explain it to me, well, he hasn't connected with that person, and there's nothing there, and it's how I'm going to invest that time. He's got so many businesses to look at, right? So you've got to think about all of this. You're talking to people. So angels on a spectrum will act they're people. They will act very differently. Some of them, it's my own money. I'm going to be really closed and guarded about it, and I'm not going to take risks because it's my money. Others are going to be real risk takers, right, on the spectrum. I love what you're doing. I back you as a human. Off you go. Here's some money. And it's not as easy as that, but there's a big spectrum. When you get to the institutional world, the the banding narrows quite a lot because everyone's generally got a similarish background and have got a similarish view on what they're doing, and they've got fund rules that they've gone to their investors about. We're going to invest in this type of business, so therefore you have to fit into that little box. And again, it's just being aware of all of these things. People go, I'm really struggling to raise. Yeah, I've gone and talked to all these people, and I look at who they've spoken to, and there might be a business that's early stage, they've got a few $100,000 of revenue, and they've gone to speak to people like Foresight, and it's like, you're not quite there yet, so you're going to get no's. Doesn't mean you're a bad business, you're just not at the stage to fit that box. You should be talking to angels, and that's the world you should be in. So again, it's trying to align yourself to where that is. Anybody got any questions, comments? I can keep talking forever, but I want to make sure.
Sorry, I've got a question. What do you think is the value of accelerators? Because, for example, like our business got into Innovate UK, didn't get the funding because that's when the government was like, okay, no more funding, but we get the support. And then obviously we're eyeing up a few other accelerator programs. And some of these accelerators, they ask for equity, right? Like 8%, 10%, and they give like 200K, 500K. So what do you think is the value of those things, say, versus angel investors? Because I kind of see those two things as they could run in parallel or instead of.
Like anything, it's highly variable. So it's like, in my world of advisory, I speak to plenty of businesses looking to sell. And the thing that I say this to everyone, whether it's an investor, it's an accelerator, or it's anything, because you'll get lots of angel investors, I'll do the world for you. You might get some VCs who I'll do the world for you. Where one or two, you'll take their investment. I've seen this with one or two before. You'll take their investment, and then they'll provide you a load of service. We'll have an office with us, and this and this and this, and then suddenly you're starting to spend that money back. So you're not getting everything you think out of it. You've got to think, if you give away equity, you can't get that back. It's gone. You just can't. You'd have to buy it back, and that's really tricky. Whereas, if you raise more money from somebody who's just a financial investor, not promising you all of this, and then you hire the expertise to do X, Y, and Z, then you're in control. Because if you hire a salesperson and they say, we've got all these connections, we're going to sell millions of your thing, and they don't do it, well, you get rid of them. And okay, you've had a cost, but you're not having an ongoing cost. Whereas if you go with an investor, don't go with them, we've got a lower valuation, but we'll do all of this for you, corporate venture arms. Not saying lots of them are good and they will do what they're saying, but sometimes if you go on that pure basis and it doesn't happen, well, there's nothing you can do about it. The equity's gone. You've signed that investment agreement. So it's like that again with accelerators. You have to be really careful. Do your own due diligence. Speak to some businesses that have been through that accelerator. Do they have a good or bad experience? Innovate UK, for example, reputable, good. Generally, I'm going to. Nick might disagree, but I'm probably going to say go for it. Anything where you can get that's got grants attached to it as well, which Innovate UK, that's free money. Why would you not go for that? If that gets you into an ecosystem where you're going to get access to better grants or something like that, well, that's probably a trade-off that you might say, that's worth doing. So you just need to look at it on an individual basis, really.
I think that is different. In the US, for example, if you've been through Y Combinator, you're going to get a load of money. It's just sort of, that's not necessarily a good thing or a bad thing, but it is a massive tick in the box. You've been through that program. You are going to go ahead in front of a load of really big VCs, and you're probably going to get a load of money. I don't think it works that way here. I couldn't tell you who the best accelerator in the country is. And so I wouldn't know, if I looked at a cap table and saw its name, I wouldn't go, ooh, that is a validation point, so I'm going to throw in a load of money. Maybe other investors do. I don't.
It's a difficult model because it used to be very much in fashion, but it's slightly difficult model because they take equity. And half of the time, those businesses don't go anywhere. So now they charge. There's one in the north of England, I think. It charges a lot of money. But the network, the idea is that they're going to connect you to lots of people, other businesses that you can sell to, other business can partner to. So in the theory, it's good. But I think, as you say, the US has some particularly strong ones. I don't think we've got one here necessarily that have come through. If you get that stamp of approval, a grant's different. Innovate UK, you free money, there's no equity. But if you get the stamp of approval from Y Combinator or Axel VC in the US, then they queue up behind them. So it's difficult. Okay, just to go back to your question about what investors, I mean, I'm very early, so I'm a first time investor in 20. So I'm going very early. They're all side hustle businesses. A lady has started a business as a side hustle, wants to make it full time, never done it before, probably early 20s. It's a good idea, otherwise would be sitting in front of me. It's global, it's scalable, it's a tech platform. Execute. Can you pull this off? That's the bottom line. You have to look them in the eye. It's different at Foresight. They're a lot way down there, they've got revenue. Maybe even EBITDA. I don't know what EBITDA is. So it's execute. Secondly, I think revenue. Revenue is the best form of investment. Probably if you've got product market fit. So I think the third thing is a if you take one thing from today, make it well-capitalized business. The number of businesses I've got that are run out, well, not running out, but they're slowed up. Jeff, you keep going on about sales all the time, mate. I haven't got any money to hire salespeople. So delay it a little bit, maybe, and get it and go for double the amount. If only, yes, you have to give a bit more equity away. Yes, you're going to start later. No one's really going to steal it. There's a number of founders that were so worried about, rightly, NDAs, rightly, so, but in reality, people, even if they stole it, they couldn't execute it. So delay it, get a bit more money in, and then make it well funded. That's the takeaway for me. What you will see is, I slightly disagree with what you said. I think everybody's slightly playing off out of position. VCs are coming earlier. Private wealth, family offices, my end of the spectrum, they're going almost anywhere. I've got a billionaire's put 2 million quid in quantum. But they're playing VC. I wouldn't say PE is coming earlier. PE is still where it is. I think VC is playing all over the park. Angels are, all the angel network that I've got, they're in their 50s, typically men. So they've sold their insurance brokerage, sold their nursery chain. They want EIS, SEIS investments. So they're going. People are playing in different positions in the UK. And can I speak to the UK?
And look, I'm interested as well to hear from particularly some of the second-time founders in the room. So I'm thinking you, Tim, Andre, perhaps. Any advice that you guys have that perhaps you're doing differently this time round to the first time?
Yeah, I'm just going to resonate with where the conversation is going and kind of give my reflections to fundraising. So just a bit of context. So historically, I've raised in total about £155,000 and not a single penny came from VC. And the way that I kind of came across my methods of fundraising is about understanding risk. And I think one of the key things I want to really get into the conversation for founders particularly is it's very easy to over-engineer approaches to fundraising, because fundraising to me, and I've turned it into a highly optimistic, and Jeff will know, when he first met me, I was like, oh, I want to do all these things and da-da-da-da. And now I'm really, really skeptical. I'm cool. I'm a happy skeptic, because you tend to realize how overly subjective it becomes. There's different approaches to your pitch deck. There's different bits of feedback you get from the pitch. It's all different. And everyone tries to capitalize on the approach for fundraising because of the naivety of founders, particularly first-time ones, that understand it. And the naivety of not understanding the terminology of risk becomes one of the key factors that either inhibit your growth or to accelerate your achievement. And so the one thing that I would say is formalize it in a way of, where does your company, in its current position, in its current activity, in its proposition, in the market vertical, in all these intersecting parameters, where does the risk align? Because the risk is what investors, by and large, look at to fundamentally, push for a decision. And I'll give you an example. My company, we're doing a raise at the moment. The raise has been quite transient. We've looked at raising just an SEIS because we're SIS, but then realizing that, with the conversations that we're having now and the type of investors that are approaching us rather than we approaching them, it's like, can we be a bit more ballsier in our raise? So, for example, I've, for the past 3 months, I've basically taken on board an investment advisor who's a VC, and paying them personally and getting quite high-level insights to how to approach raises, where the whole risk element comes into play. And so we have been preparing and basically launched an SOS race. And then out of the blue, I had 2 companies within 24 hours approach me from private equity, basically saying, do you want to stay a company? And they're both American companies. And one of them I had a meeting with last Friday. And it turned from a conversation of, do you want to sell your company to, I think I want to invest in you. And not 250,000, talking about like $5 million. And so it's all about, with the conversation and how I was navigating the conversation. You can hear me now, I'm not a first-time founder because I understand the process of risk. So when I'm telling a story, not pitching, you're taking the investor or any recipient that you want to work with through the fundamental acknowledgement of who are you, why are you doing what you're doing, and can I trust you? Risk. Are you the right person? You're the right team, you're the right vertical, all these things there to execute, to give me what I truly want, which is the return on investment. I have to also concur in what Jeff said in terms of VCs and private equity are looking earlier and earlier because, again, that same conversation, 2 P software funds, why would they want to acquire a company that's pre-revenue? Because they saw something that we're doing in the IP that we've got. So risk is key. Understand in terms of what it is you're doing. Look, index it. Am I special enough in this vertical? Use that as an index. Is my solution niche, or is it a key differentiator to any complementary or competitive alternatives out in the market? Risk. Am I generating revenue? Big risk factor. Am I in a market that's growing? So always do research into the growth rates and the market size to start to calculate, not pie in the sky, this is my TAM, SAM, like really find raw numbers. I work in AI. I've modeled my evaluation of deep research prompts in ChatGPT because the information's out there if you know how to prompt it. So there's no excuse in terms of coming up with a near enough objective valuation to what you're doing. That again is another element of calculating risk. And you basically put together your own logistical, a coefficient that says, well, actually, based on all these formulations, I see myself as, my hypothesis is I am at this level of risk. Therefore, I will speak to investors that I can portray that would satisfy that risk. Don't go for investors that, if you are high risk, go for investors that are highly conservative. There's no point. So my last bit is spray and pray never works. As passionate or as optimistic you are about your venture, about your ideas coming to life, and you have a lot of conversations with investors, and it's really good to get a team discuss. You're going to get for a lot of conversations that go absolutely nowhere. I'm being very, very real. Be more methodical in finding the right founder investor fit by doing your investor intelligence and due diligence and know how to target specifically where you're going. Because really and truly, I'm going to say this from now, your time should be invested into building your business. Do not get too distracted in fundraising, and fundraising is only valid for 2 things: for growing your company or saving it. Always put it in. I'm funding my business at the moment by launching a consultancy that's generating revenue, and I'm basically redirecting the revenue from my consultancy into a startup to get things going because I know fundraising can take a long time. So be an entrepreneur, solve problems, be as agile as you can by focusing on execution and leveraging that execution with your risk to find the right source of capital.
That fits so well with what we say all the time. We always talk about how fundraising is so easy to become a full-time job, and for us it really marks the milestones of where a business is, but it's all about the execution. Execution is what drives outcomes. So that's what we're always pushing founders within the network to do. So Sophie, we'd love to hear from you as well, with having your agency on the side and how you're approaching things differently this time round.
Yeah, I mean, they're 2 very different types of businesses. Obviously, the PR agency is a service-based business. You know, being 10 years in, it kind of runs itself. You know, I'm well networked and it's all well managed back home in Australia. Yes, I do work incredible, silly hours, given that I do work Australian time zone. But it's very different from a product-based business. I find there is a lot of risk involved with what I'm doing. But we have found gaps in the market. You know, it's up against me because I am in sexual wellness. So my conversations are already halved. I've already met with a bunch of people that go, love what you're doing, not willing to get into sexual wellness just now. So it's a really interesting time to be having these conversations. I think the fact that we've got sleep within our business makes it very palatable. And when you're talking about sex and sleep being two most primal human things that we do, and the fact that there's not much in the sleep space, I think it's really important that we're kind of covering both sex and sleep. I have moved here to find fundraising. I have moved here from Australia. You know, there's a lot of innovators, a lot of great businesses that come out of Australia. I've moved here to be taken seriously. You know, I'm on a visa. I'm here for the next 3-4 years to really make it happen. You know, we're trademarked globally. We've got a roadmap for the next 5 to 10 years, you know, of UK, EU, and then the US. We're, you know, a market leader within Australia, but now it's just about making that happen across other regions. But all the regions are very different and speak very different languages in terms of sex and sleep. So just kind of, yeah, I'm in the weeds at the moment, but I have absolute faith that, yeah, we can take on the, not to name names, but the one market share company that's in that sex space. And yeah, it's, they're very different businesses, but I've always been on the side of being uncomfortable and being in risk and going for it. And I think I've proven that with running a PR agency for the last 10 years.
Yeah, very cool. And something else that was mentioned earlier was around having some sort of management in place for your investment. And therefore you touched on it as well. Brad, I know you're working with a management firm as well. How are you finding that? Is that something you would advise today, or is that...
Maybe if you found the right one. So we're working with a fund, but we had a slight rug pulled from us recently. So we went in to raise EIS, and we're doing that with other drink brands in our space. They're creating a drink fund. And then about 2 months ago, they turned around and said to us that they're seeing the EIS market completely close, and they're wanting to move across to conversion loan notes and using the US model.
Be interesting to get your thoughts.
Yeah, I was going to ask a question at some point, which I don't know if I buy that, because I saw a lot of benefit in EIS. So they're now changing their model midway through us working with them. So we're kind of waiting to see what's going to happen there. Or we might try to find a different fund. But the process has been great. They've taken us along the journey of creating our packs, our due diligence and 5-year forecasts, everything else. So that was really helpful. But this change in how they're approaching the investment, it's a bit tricky.
Weird, really, because they have said they're going to keep EIS.
For 10 years, just been reset.
Yeah,
Sounds like nonsense.
yeah, it's literal nonsense, I think. Somebody,
Kicking down the evaluation down the road. It's good. It's a good agreement. You used to a lot of mistakes.
Yeah. The thing about EIS is I've done a very limited amount of it personally, and for every VCT investment that Foresight do, the entire team invest on an individual basis in EIS. Like the tax relief you get is amazing. It's it's really attractive. So I have no idea why, and particularly with all the stuff that's happened with pensions and all this sort of stuff at the moment, I'm amazed about that. I'd have thought EIS would be exploding.
I think maybe it's based on who they worked with previously, because I think they've got a lot of their clients who maybe haven't got the money back out of those companies, and they're now looking at having a bit more of a regular income based on CLN, so you can get interest back for a year.
Right. I think if I mention one last thing, if you just, because VCT, so it goes SEIS, EIS, VCT, I would almost always recommend, if ever you're doing it, just get some EIS money in, because it then effectively resets the clock for VCTs, and you become VCT qualifying indefinitely. So if you take 100 grand of EIS money now, you remain VCT qualifying effectively forever. And
yeah,
then
so if you take, because I do a token amount just to get it in of 10k, right? just to register it, just to bank it in case. And that, how long does that
So I don't know how SEIS versus EIS.
EIS
works,
I
but
got, yeah.
So EIS, I think it effectively makes it VCT qualifying indefinitely.
Yeah.
Yeah, I'd say not the tax expert, but yeah, my understanding is exactly the
It's
same.
quite
If
good
you
idea
pretty much
just to
take,
get, even if you get a tiny amount, that's all I did, just bank it just in case, right? And then I only had about a week left as well.
Yeah.
Someone said you need to get it in. I said, got some. Do everyone want you to invest? I said, give me 10k somewhere.
Yeah, and then suddenly you're 10k in an EIS, and then it means that if later down the road you want to talk to VCT funds, of which there is, like, it's quite a big part of it. It's £1 billion a year that gets raised, near enough.
Wow.
Across only about.
If I could contribute a hack towards this as well, something that I did recently. So my company is both SAS and EAS, Advanced Assured. And one of the things that I did is I received 2 small checks of 10k, but I wasn't ready to price it around. So there is a hack that you can do where you can combine SEIS and or EIS with advanced subscription agreements, so safe notes. So you can actually say, well, okay, if you haven't got your advanced insurance yet, or you're confident you're going to do it, you can say, right, because of what my company does, I've already done some research into where we would pass through SAS compliance. Because you need the money in now, you can say, right, I can take this money in now, not actually launch a round, and say in 6 months, you have to have 6 months of room to receive money and then do an actual round to qualify for SAS. But you can actually do an advanced subscription agreement, get the money in, figure it out, then in 6 months launch a round, distribute the shares, and there you go. So there's, I'm quite flabbergasted that advice was given to you, because really and truly it's like, if you know how to maneuver the tax system and how to position rounds by doing safe notes and everything else like that, it's more wins. You get the money in, you can use that money to experiment and to execute as quick as possible without having to go through the expedition of a round. And then once you've got your round, what you can say is, well, if you went in and priced it at this point, your valuation is going to be lower compared to 6 months of execution. You can then say, based on the terms, you can do it at ASA at a 20% discount, or in my case, there was no discount. Investors that came in at month 1 and putting money in, I said to them, it's going to be worth £2 million in 6 months. It was more than £2 million. So you have to understand how these systems can be exploited to your benefit by, again, doing a little bit of research.
What we found out is that personally on paper, I really liked EIS, SEIS, where you just buy it and got it, but it really gives a weird dynamic because people invest from abroad, for example. So we had you go with SEIS and voice safe notes at first, and then we actually did the price one, because the fact that you have a long stop date actually like demolishes the whole dynamic, in my opinion, of a safe note. Because now suddenly you have someone that has an edge, right? Like, you know, someone's going to convert at 6 months, but not you if you live in Boston. And so how do you know that you're going to be worth 2 million in 6 months?
Well, this is where, if you know, as a consultant, when I work with founders, I give them a strict rule: do not execute until strategy's done. Don't do it, because really and truly, what you should be doing as a diligent founder is to say, this strategy, similar to that strategy, upon execution of that strategy, what would I be worth? And have a optimistic and realistic valuation based on the strategy you've spent time to formulate, because the key thing about being a founder is how well you execute. And the execution is basically going to be alleviating to what your true value is. Now, when it comes to preparing for a raise, again, understand within your strategy, what is that money going to be used for? And is that money going to 1x, 2x, 5x, 10x, whatever? How well is your strategy and the team and the resources that you've basically apportioned to it is going to help with that valuation?
I hear you.
And then also another thing as well, another technique that I did is, so obviously SAS and EIS is only attributed to UK-based investors. UK and Europe is one of the most conservative regions in the world when it comes to venture capital of any format. You go to other areas of the world, their risk appetite is lower. So again, the whole thing is about risk is right. Okay, well, I know it's not working here. It's not working in London. It's not working in particular regions in the UK. Find a region in the world that has a greater risk appetite. So I went and found an American investor. The American investor had a great risk appetite. She came to me. I got in 30K that I leveraged to get another 20K. Now that 30K does not touch SAS, but it's an attraction point to bring in SAS investors. So you gotta be very brutally strategic in terms of where your money's coming from and have a wider plan to do that. Because again, these are all elements of execution that's gonna only add to your valuation because you're lowering risk. You're showing you're a savvy founder that knows how to maneuver the system.
Yeah, I know. It's like the American counterpart is at a disadvantage.
Yeah, I can definitely see that.
So that's why we had to.
But
I hear
how-
you.
how-
It's like just what we discussed at the beginning.
Oh, they can't any.
Because you have a 6-month long stop date. Like the whole point how YC treated safe is because you can't predict the future.
Yeah.
So to not price something. So I hear you, but in practice, I just don't see it. Again, with my personal experience and the founders I know here or abroad, to me, for example, when I talk to other sort of founders in the States or everywhere in Europe or in Asia, there's a real smile when I talk about our system, ASA, right? And at first I didn't get it because for founder, it sounds amazing. It's like, give me 50K and you just pay 25. But the long stop date at 6 months is really like a European implementation of SAFE, which is like, well, a SAFE is not to know about the future, but you need to know it in 6 months, which to me really is counterintuitive.
And for everyone around the table, could we, and I know you're going down the safe route as well, it'd be good, do you have a very simple definition on, we were just discussing it, I have no idea what any of this, like, advanced insurance agreement, yeah, safe note, yeah, I have no idea what a safe note is. Like, all this, I'm going to be honest, a lot of the stuff that's being talked about, I'm a little bit nervous about because people go, go off in all these directions to raise money. Complexity is bad. Complexity is the worst thing that's going to hurt your business. And I've seen it so many times. I sold a business for £30 million a couple of years ago. They did an EMI. EMI scheme is great. It's good tax efficient. They go wrong, I reckon, 50% of the time. I reckon 50%. This business sold for 30 million. There was a tax bill of nearly £5 million, which then killed the deal because it was two of the high-level employees who were going to take the business going forward. They were critical to the deal. Somebody tried to be clever in terms of their interpretation of doing, I'm going to draft this because it sounds great and we're going to decide a price in the future and everything like that. It went wrong. And of course, PwC, a top law firm, came in and looked at it, and I actually flagged it first, but came in and said, yeah, this is bad. We have to go to HMRC. Go to HMRC. What are they going to do? Oh, £5 million. Thank you very much. Of course, it's all going to get flagged up. So anything where you're adding complexity is generally bad. Come back to my original point. Everything we're talking about, revenue, is your best form of income. It's simple. It's straightforward. Doing this thing, again, talks about people to people. Yeah, foreign investors, they might not like the fact you've got EIS, advanced insurance things. We're pricing rounds differently because they're getting a tax discount, but we're not. It's a tax system thing. It's try to keep everything as simple as possible. I've seen businesses also, I had one a couple of years ago, great business, sold now, but they wanted to go and raise from the likes of Foresight. I think one of his colleagues actually looked at it and a lot were quite interested. They blocked from going into it because, coming back to your point, the initial investor, which sounded great, it's PE, they want to come and invest in this business. They don't act in this part of the world. They put it all in as a not really convertible, but a convertible loan note with such a high interest rate that rolled up. Effectively, there was debt. There was so much debt sat on the balance sheet for a new investor to come in. They were like, my money's just going to go to pay this loan off effectively. I'm not going in for growth. So great.
That's different. But like that's a convertible loan.
Yeah.
A convertible note is as old as finance. Like I'm not sure that I get your point.
Like my point is, don't like all the things that have just been discussed though. It's trying to engineer things. Advanced subscription agreements can be great, but the simple thing is, we're talking a lot of time about play the strategy of raising money in finance and things like that. It's been mentioned before. Actually, the simplest thing should be
to spend as little time as possible raising money. Valuation doesn't matter. Until you sell your business, valuation doesn't matter. Yes, the percentage that you give away matters. You need to think, how much am I going to be left with at the end? Because your pot's only going to add smaller and smaller. But whether you're worth £2 million or £20 million, I can show you a £20 million deal, which is worse than doing a £5 million deal because of how it's structured. So it's knowing that you don't know lots. Anything that's complex, I'd be wary of. That's my job.
I've got a question, James. What's the safe of me? So I think it's important that we're just all up to speed on different terminology and making sure just everyone's keeping up with this, myself included, by the way. It's just Thanksgiving is just American invention that basically you can't agree on the valuation.
Yeah.
So you kick the can down the road, but we'll give you some money and we'll sort the valuation out. It's effectively the same thing as a big now.
I've got another question actually just on this because it's getting quite detailed now, right? Because I'm quite basic and all I want to do is I've got great product and I want to get more product, right? If I worry, because I've never had funding from anyone, so now I'm thinking we scan about 20 countries, right? We could really scale. We're on airlines and everything. But if I go to a VC and once someone said, well, what you need is something that's going to be consumable. So they were looking at our product, which is a flexible head, which doesn't break, right? It's really good, well engineered. Actually designed from sex toys, the headroom.
There you go.
Because the material has to feel nice on the skin, right? So
Durable.
So anyway, yeah. So, but when I went to a VC, they were trying to use my product as a Trojan horse to get into the hair loss market, right? I'm thinking, no, this is not what we're about. So my worry is about losing control on what you're trying to do just because someone thinks it's money.
But that's done should be the biggest. Founder invested, but
The whole landscape has changed. I've been here 3 years, and I came here for a strategic tactical reason. I'm a founder of companies in the U.S. and sold basically never raised money other than our own in a group, and we continue to exit it out. And I'm here because I'm in technology, and before I wasn't. I'm not a techie, but I find the people who have the technology aspect. So, but the thing is, change here. First thing is here is basically, and here's a landscape. As you mentioned earlier, Nick, regarding investors here invest to be safe. Maybe 2 or 3 returns are happy. A U.S. investor will take the risk, take less equity, give you a hell of a lot more money for a 7 to 10 exit to win. The other thing that happens as well is that at the same time is that currently now, I'm thinking I might go back because everybody's not talking about the Delaware flip.
Yes.
All right, because they're figuring I'm going to go where the people are less resistance, have vision, take a little bit of risk, bigger return, gives me more money to win. Because you can get some money from somebody, but just enough to stay alive is not going to help you at all. You have to have enough injection of infusion cash to be able to win. And unfortunately, that's not the landscape here in the UK. Where I'm even considering going back, because I'm here sponsored, as you know, I'm here endorsed and sponsored by the UK Department of Business and Trade, the UK government, under their Global Entrepreneur Program. I'm one of 100 companies. I've already said, I want to invite these tech companies for office to headquarter their offices in the UK. And I'm one of those 100 companies. And I tell you what, it's been a struggle. All right, been a real struggle. And I feel strongly what we have is something totally unique in the industry, solves a major problem, but people want to play it safe.
So on that then, and one thing I'm really keen that we get to on this is, obviously we've got the very short term front of mind for all of us. How do we get through this next product launch, build the team, whatever it may be that's front of mind? But it's really this cat table cleanliness. How do we do it in a way where we're bringing the right people on board, where it doesn't come back to bite us in the next round? And I'd love to hear from you on that.
Yeah, things that I said before, it's simplicity. The simpler your cap table is, it's not going to, because you've got more angels, isn't going to stop some of the investing later on, but it's simplicity to what you're doing. I think, again, I just want to take it back a level that everything's been said here is there is no one size fits all. Everybody in this room will have a different approach. And it's what I said at the beginning, it's humans dealing with humans in every part of business. There are people in this room who, your impression as being, the UK is too slow in investment. For you and the number of others in that room, if you're trying to be a unicorn, you're trying to fly to that position, the UK investment market, it's not impossible, but isn't designed that way. The US is more aligned with that. And mentally, you're more like there. You're unlikely to go I should just go and raise in the US. you really need a presence there to have proper chance. You can. There's always exceptions, and you'll hear lots of stories. They're always, if they're stories, they're the exception. People don't talk about the normal; they talk about the exception to the rule. The reality is, you want to be in the US, you need to be in the US really and have a focus there. But if your mindset's that, you'll have better luck on that side. If your aim is I want to grow a business that I know is going to be successful and work. Nick talked about this from the beginning. The UK to more the market. So it's thinking about everything that aligns. That's actually the biggest thing to the cap table point of where does it go wrong. It's not the structure of it. It's not how many names I've got. It's not how they've invested, what scheme are they under, etc. It's usually where there's a misalignment of views and opinions. That's where you get arguments around the board table. And this is not just investors, this is founders. This is all sorts of people. I see this sometimes. Why do certain businesses sell? The founders have fallen out. They can't agree. So the only route forward is they're both going to sell, and one might try and buy the other one, but they can't, and all sorts of things here. Where people you sign an illegal document. In all of this, you'll sign a legal document. If you get on with your investor or co-founder or whatever, you'll never get that out the drawer again, because you'll just sit in a table in a room and everything you agree will supersede that. That's there for when you don't agree. And everyone's going to be friends when you're doing a deal because you're shaking hands. But you really need to, somebody talked about investor due diligence before. It's that thing. Yeah, you can do your Googling, you can do your chat GPTing or whatever. Go and have a drink with them down the pub. Go and have a couple of pints where they relax a bit more and have that conversation. Can you talk about something that's a bit more awkward or whatever? Can you actually think, this is a guy I want when things are going wrong? If it all goes great, you never have to work out. If something's going wrong, will they support me? Will they stand by me? Will we have a similar ideology and philosophies to things? Because that's the most important thing that you can think of. Who do I get on with? And it's the same with everything in business, I'm sure. Service business we talk about. It's the same thing. People buy services based on who they get on with and trust. It's the same thing. Not everyone's going to have, and that's not going to be the same person for everyone. So you just need to go and work out, look at yourself and go, what am I trying to achieve? I think we mentioned it before in terms of going scattergunning out there. You need to approach, if you're trying to go, we've got a huge market and we're going to be a unicorn, it might not be the person to go and talk to because his risk appetite is different way up. Whereas somebody else might well be. So it's just trying to think of where do I fit on that risk spectrum. I've got a founder at the moment. The thing she says on it was, I've started a business before, we ran out of cash, it hurt me. I'm never going to have a business. I have a remote risk to run out of cash again. I don't really even I'm going to raise some money. I don't want to spend too much of it, to be completely honest, but I just want it's the safety so I can be more aggressive for how I grow. That's a very different approach to some other people. Neither is right, neither is wrong. You're going to go on different paths and journeys. So just work out where you align on that risk.
The only thing firstly, I would still love unicorns. Fine. And the only something that I'm living through at the moment, and this is just a word of caution, is comes back to that point of things when things don't go that well. I'm on the board of a business where there is a founder director, but not an executive. And I believe they behave very badly when we're going through further rounds where their sole view around the board is to protect their own dilution to the detriment of the company. So we need to put more money in to continue to grow the business. But they have done things which have delayed fundraising, which have fiddled with the valuation, all this sort of stuff, and it has driven us to a point where our options just get fewer and fewer and fewer. And so that is, forgive me, some of the problems with angels can be. They've got their own skin in the game, and they can just be going, where's my pound coming back? And so that's just another word of caution about who you go into bed with. Are they there long run? Can they follow? Can they not? How's that going to work? When the sort of rubber hits the road, are they going to be looking at how do we look after the interests of all shareholders? Or are they going to be going, where the fuck's my pound coming back from?
Yeah. And Michael, does that sort of answer I know you were intrigued around finding mission-aligned investors as well. Is that a similar sort of tack in terms of?
Yeah, sort of. I have a question, which is, I guess I can do what I need to do without raising money. I'll just do it a lot more slowly. And maybe that means I'm just too early. Like I don't need funding at this stage. But then the other side of it is I would be open to entertaining conversations with investors that are mission aligned, that do get it, that do want to kind of invest in my space and me as a founder. But it kind of flips the whole thing on its head. I don't want to be chasing money. I want money to be chasing me. And maybe that's naive and ridiculously optimistic, but how do you make that happen?
You've got to make some present. You have to look at one of the things that I do, and the reason why money's chasing me, relatively speaking, now is I make my presence known as far as possible. So do not feel afraid. And although it's one of the death words of investors, VCs, branding. What's a brand? And it's true, right? You don't have a brand unless you've got a product. But when it comes to a personal brand, if you have something in you, in your repertoire, that can be seen as enticing, as exciting, as the concept of you as a professional, you as a contributor, lowers that risk and enhances that appeal. If you, for example, use LinkedIn, right? Do posts, contribute to thought pieces, contribute to narratives and conversations, hack into various general, issues that are happening in the world from your perspective, hashtag the hell out of it so that it goes into multiple feeds. Because what you want to do is you want to make yourself as present as possible for just in case you fit into the timeline of an angel investor that is mission aligned, that can say, oh, this is quite interesting, or you might get someone following you on LinkedIn, like, who's this person? Look into it, like, oh, this is someone who's exited to a business that, potentially that could come on board, and maybe not as an angel investor, as an advisor, to help lower the risk, and so on and so forth. The more present you make yourself, the more relatively accessible you make yourself, the more opportunities you have in terms of having those conversations that are meaningful and impactful to ensure there's alignment. This day and age now, the amount of times I've been approached to, oh, we've got this pitching event, I say, no, thank you. I don't pitch anymore. I have conversations. Sit down, like we said, go for a coffee, go for a drink, in person or even virtual, and have conversations, and don't even talk about your business, just have conversations so they get to people buy self in people. So if they have that natural alignment with you that say, I like you, if they like you, they want to back you in what you're doing, because now the conversations that I'm having that are quite forceful after doing those initial 3 months of least context dating, potential investors.
Yeah.
And he's like, I like you. Okay, so you understand what I'm doing now? Yes. Okay, great. Do you like me? Do you trust me? Are you going to back me? And when you get to this type of conversations and say in that type of conviction, that's when you're in a position to say, okay, so I've met someone that's not just met my value and worth, but I rise to my mission.
Well, can I just ask a follow-up? So you're talking about being present. I'm a big supporter of LinkedIn and being present on LinkedIn, but how do you kind of portray the fact that I've got this business and I'm looking for investment? Because I think the question kind of was a bit more close of trying to get that people are coming to you and saying, oh, I like what you're doing. What's your strategy or something like that? But how does that come across? Is it just generally talking about?
I never talk about investment.
No, this is it. You can't you? Like, it's not about doing that.
You want to have the appeal of someone who knows their shit. Like, I'm doing this with or without you. With you, I can do it a lot faster, a lot sooner, a lot better.
But then is that to kind of then to sort of take a conversation offline to kind of connect? Is it a tool to connect with people and then be able to sort of
you want to come alone, Rod. What you do when you are out there doing content, whether it's blog posts or you've got content creators out there that are looking for interesting people, particularly founders that want to tell their story, do them. I get approached probably at least once a week to do a podcast, and I've got quite a bit of content out there that tells my story, in which, again, though that's the content steps into the narratives of various different people of interest that you can fulfill, whether it's investment, whether it's whatever else. But what you do is you make it known about your story. The story has to build a narrative of trust and integrity. And once you've got that framework of trust and integrity in your story, they'll naturally ask you about your business, the intent of your business. the purpose of your business. Where do you want to take it? What's your mechanisms of execution? All those things there. Talk about all those things. Have those conversations. Make sure it's a natural, organic flow. Because if someone who's actually interested in investing in you, they'll come and say, "Are you raising at the moment?" That is the trigger to then say, "Okay, now the conversation is now changing into, oh, we're talking about money here." But don't be attracted to let's talk about money. Talk about how you're gonna how if you like what I'm doing, how you're gonna support. Especially when it comes to angels, how you can support and let them and literally have a conversation. Sit down, awkward silence, and let them respond. How you want to support, and let them tell you where it is, because whatever they have, that's value. Leverage it to get to your next destination.
Okay, look, I am very conscious of time. We have about 10 minutes left. So there are a couple of, I think, quicker fire conversations to just polish off as well. So, I know you mentioned about wanting to discuss documentation and platforms and that side of things that you get
yes.
on.
Maybe.
Is there anything top of mind that...
No, it was just more a question, because I know there's lots of platforms. There's Sid Legals, there's, I know, Carter, whatever. Are there any VCs, do they care really about that? Or is it just a question of having a cap table and that's it? And then the rest kind of follows through. Same with the angels. I don't think Jeff is here now, but
if you, by the time you get to an institutional round, you want to be, the platforms that you manage up to that point, I don't think really matters. You've got a cap table. By the time you start taking on an institutional investor, you want to appoint a lawyer who has done lots of the sorts of rounds that you're doing, because legal documents are terrifying. They have all sorts of things in them which deal with the nuclear outcome. And you need a lawyer who can go, that's standard, that's not. They're trying to pull your trousers down there. And all of this stuff won't ever happen. It's just there. And you have to accept it. And you need someone who's seen it lots and lots of times and can say, this is what happens. Like the biggest ones are leaver provisions, for example. And there will be a clause in there that says, if you are a bad leaver, you lose all your shares. And you need someone who can tell you that will only happen if you are caught defrauding the company. It is entirely your decision to do that. If you do that, not only lose shares, you're probably going to jail as well. So it's your fault. It sounds scary, but it's entirely at your own discretion if you do it. So just don't do it. And that's sort of, you need someone who can have those firm commercial conversations and say what's real and what's not. But so getting someone you get on with as a lawyer is also a very good decision, because they are horrifying things that we've got.
Yeah, you mentioned that on our conversation.
Yeah, you don't want to spend lots of money too early, right? Coming back, I've seen people do this. Yeah, they go and build Rome in a day, and they try and make everything so great. But it's like, unless you actually get there, it's all irrelevant. Unless you're into the position where you're going to be raising the money or selling the business. So do it at the right stage. But I agree, back to what I said before, simplicity. The simpler things are, there's the less that you kind of fucked up, for want of a better phrase, along the way, that's going to cause you a problem when you go, and get to the legal documents or whatever. You haven't got this weird, if you put something in there, generally it's quite hard to get it back out. Just what happens is you agree something with an angel, the next angel goes, oh, I like the look of that, I'll keep that in there, and you add on and add on. As a founder, more and more weight just gets attracted and put on you. Just standards, try to avoid going down a route unless it's really, really valuable to you. Just keep everything as clean and simple as possible, because then it's easier.
Yeah. And if you've got articles and things like that, everything you do up until the point that an institutional investor sort of becomes irrelevant, because we'll just put new articles on top anyway. And so it's sort of everything you do beforehand is, that's great, you've done that, but we have our own template legals, and unless there's a very, very good reason for us not to use them, we will. And the only reasons I've seen where we haven't is because we are syndicating with someone else whose templates we like as much as ours, or because there's an international investor in it, and so we need to base it on American legals or something like that. Otherwise, we will just put our template articles and so on.
Any other burning questions or anything?
Can I ask, you mentioned that any company should have EIS investment in order to be qualified for VC investments. Is it like a
which is a specific, it's
okay.
the big brother of EIS.
Okay.
So where you can raise more money. I can't remember what the EIS cap is, but let's say it's $1 million.
Okay.
BCTs is 12 or 20, and it's sort of the next thing up. So
Okay.
it's just, and the BCTs have the same limitations around the age of the company, the use of the funds and that sort of stuff. It's just sort of a natural progression up.
Okay.
Perfect. Anyone else to ask me those questions?
Yeah. Exactly the gent is gone, but
Jackie.
a couple of people mentioned, I think maybe yourself, or you mentioned about using a firm at the moment to help finding funding. Is that, I was a bit curious about, because I've never really thought of using a firm to kind of go and find that funding. I don't know whether that's for VC or whether that was angel funding that you were talking about, or I've misunderstood what it was. It's generally who does
So I don't know if you guys can.
There are like pitching type events. They're not necessarily pure pitching, but there are platforms out there. So I'm trying to remember. There's things like Syndicate Room, Angels Den, etc. They're things where they will have a group of angels who purportedly are interested in doing it, and they'll put you in front of them and take a fee for it.
Oh, okay. There's not firms that are specifically going out and looking for you.
Yeah, so that, I'll advise, but I won't advise at a seed stage. You know, generally in our world, the answer is, and this is something to consider just for anything, which is, it's the same amount of work, Nickel Rivers, it's the same amount of work to put £2 million out the door as if it's £5 million door. It's the same in my world of advising. You know, really, I want to be selling a business for £50 million. That's what I want to be doing, because it's the same amount of work to be raising somebody £2 million to do that, to help them along the journey. So there are people who might help at a seed stage. I'll be honest, I'd be quite surprised if they're of a good quality, because I'd be questioning why they're working at that to make the economics work out. You know, if you ever do work with somebody, as much as possible of it should be on contingent. If somebody's like, "I'll come and help you and pay me a monthly retainer" type thing, I'd always be, you know, when I sell a business, I'll have a small amount up front. 90+% of the amount I'll earn from that is going to be contingent based on how much they sell, and the more they sell for, the more money I'll get. So it's, you know, it's aligning yourself with somebody like that. But yeah, really, I think the friend over there touched on that. Is if you go out angels, it's making yourself visible. It's, you know, there's marketing and there's selling. The same as anything else in business. Marketing is just somebody might find you. That's not really controllable. You know, do it, that's fine. Direct selling, you know, just go out and reach out to people. And I think one of the points was, how do you create that inbound interest and everything? Go and talk to some people and say, I'm going to do this. The biggest validation point you can do is then do it. Because then when you say you're going to do something else, you've got a big tick in the box, because somebody's seen you do what, put your money where your mouth is, literally, and that makes you near backable, more interested in that. It's the same when I sell a business. I say, go out and talk to the buyers, say you're going to go and do, you know, 20 million of revenue and £3 million profit next year, do it. Because when you say next year I'm going to do 25 and 4, it's a lot more believable now, because you've seen that in action. I don't know about foresight. Actually, maybe it was Amy that's telling this. Somebody told me from one of the VCs, they've done a bit of, no, it's BGF, that's sorry. They've said the average time they tracked a business before they invested in it was 3 years or something like that. Wow. I'm not saying that's standard only in mine, I wouldn't say, but like, that is just something they've known people before, and they've seen them grow up and do the same thing. It's the same with the business I work from when they're selling them. I generally like to know them for a good amount of time, because you get to build that interpersonal relationship again, and all the things we've talked about. So thinking tomorrow, obviously angel investment, you're raising it, you need the money now, we're not going to wait 3 years, but just bear these sorts of things in mind.
Yeah. Amazing. Well, look, we are pretty much out of time. I think we've kind of seen that this is such a huge and complex topic. I think we probably could have sat here for the day and really dived into it. So I think it's a case of, let's take the learnings from today. What we'll do is we'll put all of this in a roundup email for you, so you've got it. And we'll connect everyone so you can continue conversations from the day as well. Coming up for our members, we've got some exciting events. So next month we have got a branding masterclass with Kuba, who founded Eastleigh Services. Following that, we have a founder spotlight with Tess Kostad of Bayer Fertility. So really health tech hardware, how they've got it through all the processes and how they've finally got it out to market. And hopefully you've seen that we're also hosting Found London, our big conference towards the end of the year.
which is included as part of your membership. We have just confirmed the guys from Runner. They're going to be speaking at that and sharing what I like to call it the unPR'd version of their story, which will be interesting. But for now, thank you so much for coming out. Big thank you to Andy for your overheads and bits for contributions as well. Hope you enjoy the rest of the day, and we'll see you soon.
Thanks.
Thank you.
Thank you.